Hello, I'm Aditya and welcome to Arthvad. The idea here is simple. Each episode, I take developments from the world of fintech and financial services that actually matter and break it down. Not just what happened, but why it happened, what it signals, and what it opens up for the people building. There's no shortage of noise in this space, but most of it is just reporting. Arthvad is meant to be the opposite. Fewer stories, more thinking, one shift at a time looked at properly from the perspective of someone who's watching this ecosystem up close. So let's get into it. Today, I want to talk about something the RBI did last month. In June, it eased up on a large part of the NBFC sector. The ones under 1,000 crore that don't take public funds and don't deal with customers directly no longer have to stay registered with it. And they've been freed from needing prior approval to expand their branch network. For a lot of these firms, that's a genuine reduction in the compliance load they've carried for years. And around the same time, the RBI also moved on the consumer side. It proposed that every recurring auto-debit, subscriptions, EMIs, anything on the standing instruction, come with a notification before the money actually leaves your account. So you see it coming and get a window to stop it. What I find interesting here is that the same instinct is showing up well beyond India. In the US, the Fed is looking at whether non-bank fintechs should be able to plug directly into the payment rails, and regulators have been steadily filling in the Genius Act framework around stablecoins. In the UK, the FCA has started letting banks run agentic AI in live operations and has said plainly it won't write special rules for it, even as the NCSC wants that those same systems carry real security risks. So different markets, different specifics, but the direction seems very similar. And when you sit with it, the logic also gets pretty clear. The regulators are easing off where the risk is contained. A small lender with no public money and no customers can't really do much damage to the system. And it's leaning in where the risk actually reaches people, which right now is fraud, moving faster than anyone can react to. So they aren't getting stricter or looser across the board. They're getting more deliberate about where their attention goes. And they're sorting the system into a lane for institutions and a lane for everyone else. So if you're building, that's worth holding on to because it tells you where the friction is heading. On the infrastructure and the B2B side, the path is genuinely opening up. The regulatory weight is lifting off exactly the kind of work that doesn't touch consumers directly, but the closer your product sits to someone's money and someone's attention, the more that scrutiny becomes the ground you operate on. Compliance there isn't a tax that you pay at the end, but more and more it's the thing that decides whether the product can exist at all. The teams that get this early and treat trust as a part of what they're building rather than a hurdle in the way of it are the ones this whole shift quietly favors. That's how I'm reading it. I'm Aditya, this is Arthvad.